Household finance confidence fell again in August, according to our surveys. So we discussed the results and examined what caused the fall. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. We've released the August 2017 edition of our Household Finance Confidence Index, which uses data from our 52,000 household surveys and core market model to examine trends over time. Overall, households scored 98.6 compared with 99.3 last month, and this continues the drift below the neutral measure of 100. This is an average score, and there are significant variations within our various segments. By way of background, these results are derived from our household surveys, averaged across Australia. We have 52,000 households in our sample at any one time. We include detailed questions covering various aspects of a household's financial footprint. The index measures how households are feeling about their financial health. To calculate the index, we ask questions which cover a number of different dimensions. We start by asking households how confident they are feeling about their job security, whether their real income has risen or fallen in the past year, their view of their costs of living over the same period, whether they've increased their loans and other outstanding debts, including credit cards, and whether they are saving more than last year. Finally, we ask about their overall change in net worth over the past 12 months, and by net worth, we mean net assets less outstanding debts. Younger households are overall less confident about their financial status, whilst those in the 50 to 60 year age band are most confident. This is directly linked to the financial assets they hold, including property and other investments, and their relative incomes. Households over 60 years old track quite closely to the national averages. For the first time in more than a year, households in Victoria are more confident than those in New South Wales, whilst there was relatively little change across the other states. One of the main reasons for the change in New South Wales can be traced directly to the state of the investment property sector, where we see a significant fall in the number of households intending to purchase in the next few months, and more intending to sell. One significant observation is the rising number of investors selling in Sydney to lock in capital growth, and seeking to buy in regional areas or interstate, and Adelaide is a particular area of interest. Consistent with our earlier analysis, a household's property owning status has a significant impact on their relative financial confidence, with owner-occupied households the most confident, ahead of property investors and those renting. That said, low rental growth means that more investors are underwater on a cash flow basis, especially in Victoria, where more than half are not covering the borrowing costs of their investment mortgages from the rental receipts. But they are still hopeful of capital gains, and of course they can offset the losses thanks to tax breaks. Actually, returns are much stronger in Queensland and Tasmania. Looking at the scorecard, job security remained about the same this month, but there was a 1.7% fall in those more comfortable with their savings and a rise of 2.5% of those less comfortable, thanks to lower interest rates on deposits as banks seek to build margin. The debt burden remained a concern, with a small rise in those worried about meeting repayments on outstanding loans. Incomes are still under pressure, with more saying their incomes in real terms have been devalued, down 1% to 52% of all households. Costs of living continue to rise for 63% of households, and only 7% saw a fall. 65% of households said that their overall net worth rose again thanks mainly to home prices rising. But some in Western Australia and Queensland reported a fall, directly due to home values continuing to slip. Given the fact that the dynamics of the economy seem to be locked in place, with lower income growth, rising costs of living, and the property market adjusting to the new regulatory environment, we expect confidence to continue to drift lower in the months ahead. There is no obvious circuit breaker available in the current low interest rate, low growth environment. The leading indicators suggest that the recent positive momentum in the property market may be short-lived. We will update the results again next month. I'm Martin North from Digital Finance Analytics. Thanks for watching.